Hello, everyone, and welcome to today's Sherpa Funds Technology Process Alpha webinar. We're doing this at a little bit different time, so if you're joining us here in Asia, good afternoon. If you're one of the people who signed up to join us this special sort of pre-market time in Europe, good morning. If you're joining us from the US, I'm sorry. It's just a bit of a
Well done.
strange time. Um, so today we're going to be talking about Sherpa's 5 steps for better portfolio construction. And so this, just for reference for everybody who's partaken in a Sherpa webinar before, this is sort of a webinar that's not going to be as detailed, not going to be as technical, but it's going to focus on tying the different pieces together and how they sort of fit together into a whole replicable process for portfolio construction. So if you haven't joined us before, my name is Stephen Quimby. I'm joined by our founder and CEO, Richard Waddington. Richard, do you want to tell the people hello?
Hello, everybody. Nice to see you.
So today we're going to take a 30 minutes is usually our timeline. We'll see if it's a little bit shorter, a little bit longer, but we're going to shoot for about half an hour. We're going to walk through an introduction. We're going to go through each of our 5 steps for better portfolio construction, and then we'll take any questions you might have at the end. If you think it's particularly relevant at the time and just can't wait to get it in there, feel free to put it in the chat in the webinar tool, and we'll try to get to it midway. Otherwise, we'll certainly, like I say, take all the time we need to answer questions at the end. So, what are we talking about today? And so, we're going to take kind of a step back to a very high level concept to start us off. So, what we're showing here is sort of a stylized value chain for asset management. And in this chain, you can see that we have asset selection, portfolio construction, trading, which creates the product. So you take your assets, select them, build them into a portfolio, execute, and then you have your products. And then ultimately those go out to clients, go out to investors. So sales, investor relations. And so what we're going to focus today on is the portfolio construction piece, because this is one that, in our experience at Sherpa, many managers spend most of their time on the alpha generation, the asset selection. Trading is obviously a very well known sort of problem on its own, and sales is kind of a separate concern. But many times the portfolio construction piece isn't a very well defined or scalable process for fund managers, and that causes them to lose or to be unable to capture all the value that's generated from their asset selections. So when we think about portfolio construction as a process here at Sherpa, we have a framework that we call our 5 steps. So the 5 steps here for better portfolio construction. And these steps in this case are understand, define, calculate, explain, and manage. And so these 5 steps really are a framework that enables PMs to both use systematic portfolio construction methods, but also to bring a more structured, regimented, as Richard likes to say, Toyota style process to portfolio construction, which enables sort of a culture of continuous improvement. You can understand the different pieces of the portfolio construction process at a more granular level. And so these are the steps that, manager to manager, what you do, how you go about measuring different pieces, the tools you use to understand or explain. Those might vary, but broadly speaking, these are the things that you should be thinking about if you have a robust portfolio construction process. So when we talk about these 5 steps, the first is understanding the alpha. So understanding the alpha sets the page for what types of portfolio are possible and for many of the decisions further down the line in terms of what portfolio you actually want to build and then which ideas you're going to sort of implement in which way. The second step is definition. And so definition is, given that set of ideas, what's the shape of the portfolio that's going to meet my organizational and investor requirements to implement and deliver the alpha in my ideas? Third is what we call calculate. And so calculate in your traditional portfolio management process is kind of a fuzzy heuristic process where basically when they say calculate, it's the PM's brain sort of adjusting position sizes up and down by 10 bips here and there. But in process, calculation, whether it's a systematic tool or a heuristic tool, means building or calculating the sizes, calculating the portfolio that is the best portfolio that will express the alpha from step 1, compliant with the shape in step 2. The fourth step is explanation. And so explanation means, how does that best portfolio that you've generated in 3, how do you understand it? How do you dive down into the details? How do you take the information that you've generated in 3 and improve on that, or choose from the outputs, if you will, of the calculation, which ones you're going to implement? And then finally, step 5, managing the workflow. It's managing the whole process. It's making sure that this is done on a regular, replicable basis and that you're understanding what's working and what's not so that you can improve over time to do a better job, frankly, in portfolio construction. So we're going to take this one step at a time. And so we said, remember, our framework here is understand, define, calculate, explain, and manage. So step 1 is about understanding the PM's alpha. So understanding what your ideas are, where they're sourced, and what their sort of quality is that you're going to try to implement in the portfolio. So if we were to sum this up in kind of 3 sort of high-level questions, if you will, the first thing we need to think about is how do you select assets for the portfolio? Second is how do you express your views on those assets, be that scoring, expected return, or another mechanism? And then third, what is the information content? Sort of what's your expectation of those assets? What's your expectation of those scores? What do you expect to see as a bias potentially within your ideas? So this is a really important place to start, because if you don't understand your ideas, you're going to be building a portfolio where you're not entirely sure what it is you're actually trying to maximize the expression or the exposure to. So you have to first understand your ideas so that you are well positioned to build a portfolio that expresses whatever is good about those ideas. And so we think about this frequently in terms of some simple metrics or some simple ideas. So in addition to how do we select our ideas, how many ideas do you have at a given time? So how many names are in the portfolio? How many are in the watch list? How many names would you be comfortable owning? Things like that. How well have those ideas tended to perform? So depending on how you think about your ideas, whether you think about them all sort of as the same portfolio of lottery tickets, whether you think about high conviction, medium conviction, low conviction, whether you group them by expected returns, how well do your ideas tend to perform? And then finally, we should also think about how risky have those ideas been. And so this is, from a best practices perspective, this is a question of analyzing and interrogating your track record. Analyzing and interrogating not the results of the portfolio, but the results of the individual names, the individual ideas that you've had through time to understand, what would you expect from those ideas on their own. So these simple metrics, like we say, are an easy place to start. So this doesn't need to be the most complicated quantitative task. We talk about this in another webinar where we go into testing sensitivity to some of these assumptions and sort of really diving into this in a bit more detail. But broadly speaking, you can use very simple, easy to calculate metrics to start with this, to start to understand your track record, understand your ideas through time. And so if we take these, and so in this case, we've taken the number of ideas we have for a given score for a signal through time. So a signal could be a PM, could be a systematic signal, but a set of alpha ideas. We're looking at the return of those ideas, the volatility of those ideas, the drawdown of those ideas, and then just sort of as another descriptive measure, the Sharpe ratio. And so this gives us a fairly clear picture. If we've taken these ideas grouped by score, we can see, for instance, that the score 1 assets in this case have much higher risk, much greater volatility than any of the other assets. So while the score 1 assets in this particular sample had the highest returns, they actually were the riskiest ideas. Or we can look and we can say that practically speaking, the scores 3, 4, and 5, we had many more of those ideas in those conviction buckets relative to 1 and 2, where at any given time, the PM only had a few ideas of that quality, of that caliber. So this is to paint the picture to say, if we're going to build a portfolio where we have these assets scored 1 through 5, we need to think, what do we want exposure to? How much can we actually put in the 1s when there's only 4 1s at a time? Or how much do we want to trust the 4s, where maybe the 4s over time have been the assets that have performed the worst? So thinking about this starts to inform some of, again, the decisions that we're going to make about actually constructing a portfolio from these ideas. And so we can then take this to the next step. And again, if you want to get into any of the detailed math on this, by all means, check out the other webinars we have on our YouTube channel, or feel free to reach out. We're not going to go into the weeds today, but we've talked about most of these topics in a little bit more detail before. But the other thing that we need to take out of our ideas is what sort of bias do we maybe have in our process? So any research process is going to have, if it's a replicable process, naturally some amount of bias, some persistent characteristics where it tends to select ideas that have some sort of consistency, some sort of commonality, if you will. And so in this case, if we looked at this signal had a very strong pro-growth, anti-value bias. Now, from a portfolio construction perspective, that's telling us that if we don't control for that, if we're not consciously creating a portfolio that mitigates that growth versus value tilt, we're going to end up with a portfolio that has a huge growth exposure and a huge short value exposure. Maybe that's acceptable, maybe not. But fundamentally, if you don't do this analysis, you're going to end up with that exposure inadvertently or unintentionally. So step one is understanding our ideas. So understanding basically how they've performed, basically, the different types of scores, how we're generating those ideas, what types of bias that process might result in. Step two then is to start to define the shape of the portfolio that we want to use to implement those ideas. So when we talk about the shape, that means the objectives, the constraints that make this portfolio investable for the PM and for the PM's organization. So if we, again, were to summarize into simple questions, we can think, what's the goal of the portfolio? What shape or set of definitions meets the organization's requirements? And then ultimately, how much risk is the PM comfortable with that portfolio taking? So if we sort of take the next step and start taking those ideas and creating a portfolio from them, we can see in this example, again, tracing back to some previous work we've done, a different webinar, we can see the same ideas packaged in different types of portfolios produce very different results. So this is, in this case, long short equity ideas. We have a 130-30, a long bias, a market neutral, cash neutral portfolio, and then a fully factor neutralized, maximized specific risk portfolio. All four of these would be a viable and legitimate expression of the alpha in the ideas in the previous signal. But the question really is, which one do you want? What's your goal? Is your goal to retain market risk? Is your goal to mitigate all your market risk? Do you want some exposure to the market? So first we have to ask, what do we want with the portfolio? Usually this is going to be well defined in a mandate. I mean, we can see here from a risk attribution perspective, the degree to which the different risk factors are driving the results in each portfolio. In the 130-30, the market's the overwhelming driver. In the long bias, you start to see more specific stock picking or idiosyncratic risk creep in. Cash, the factor neutral, sort of steadily creep up. Now, any of these could be fine, and depending on what you've sold your investors, any of these are acceptable, but you have to make a conscious choice what shape you want and how does that align with your goals. And so then once you have that, once you know sort of the general shape of the portfolio, then it comes into taking the details. So if you've taken the stone and sort of made your rough cut, now you have to chisel in all of the little tiny detailed bits to actually make the sculpture. And so this is going to require bringing in many different stakeholders. So this requires bringing in the CIO, maybe risk, maybe trading, maybe sales, maybe you have a product team. The PM has their own views that they'd like to express. Maybe the analysts have a seat at the table. So these are all the different stakeholders that might have different constraints or different views that need to be expressed in this shape of the portfolio. And reconciling all of these different stakeholders, reconciling all of these different moving parts is what ultimately defines the shape of the portfolio in a way that you can bring tools to bear to calculate the portfolio. So when we've done this, if we do this, again, this is something we'll go into in more detail in another session, but once you've done this, a formal shape can be expressed as a series of constraints and a series of goals and a series of really precise expressions of what you want that portfolio to look like to make it investable. And so in this case, we've grouped these constraints by portfolio level, group level, and asset level. And you can see in this case, there are quite a few different things, quite a few different elements that are maybe coming about either as regards a regulatory constraint. In this case, this fund is an income fund. It has a yield constraint that has to be above a certain area. You can see that there are constraints that maybe are placed purely as a factor of the analyst and the research generation process in terms of conviction. But ultimately, this shape is going to drive how the portfolio gets built. And so if your shape is complete, in Sherpa terminology, what we call our 3Cs framework, a shape needs to be complete, coherent, and consistent. If the shape meets the 3Cs, if you understand your alpha, you've defined a portfolio that meets the criteria that you want for the organization, you can use these 3Cs to assess whether your shape is really fully defined. And then at this point, you're ready to start thinking about how you can calculate the solution. So once we've defined our shape, evaluated our shape, understood the alpha, understood the inputs, at this point, we're really close to being able to bring systematic tools, or ultimately, if you do this heuristically, sort of your fuzzy brain is a tool to bear. But the last question we have to ask is, how much risk do you want to take? And so in this case, we're looking at 4 different portfolios expressed with the same shape, the same alpha, the same criteria, just accepting different levels of risk. And so again, we can see that the results vary considerably, but all 4 of these portfolios would be an acceptable solution depending on what the PM wants and depending on what's consistent with their organization. And so calculating the solution that expresses your alpha, subject to that shape, taking the amount of risk and the type of risk you want, is really what systematic and scalable portfolio construction is all about. So Richard, walk us through the nuts and bolts here. How does the math work?
So thanks, Stephen. Without getting into, we don't in this webinar want to get into this in too much detail. But as Stephen says, right, you can only start doing the interesting maths part once you've done the definition and shape setup, the understanding and the defined part that Stephen's just talked about. Once you've done that, we can now start asking the maths process for a solution, right? Because fundamentally, it's a solution. You have a multivariate problem. You've got, 50, 100 assets. So you have a multivariate problem and you want a solution which gives you the best portfolio. And that should be one that is consistent with the shape, that expresses the alpha, and that is evaluated in a sort of sensible, systematic way, a repeatable way that makes sense. So the first thing to really think about is, what possible portfolios can you have? So, and again, we did a full webinar on this issue of candidate portfolios, but the point is that once you've done all the work that Stephen talked about, you are left with a set of possible portfolios you could produce. Each one is compliant with that table that Stephen showed. Each asset was within its minimum and maximum size. The groups, so the sector or the factor risk is within its boundaries. The actual overall portfolio, in Stephen's case, has a yield between, I think, 2.4 and 3 and a bit, whatever. So you can produce there's a whole possible set of, call them candidate portfolios, that you could produce that are compliant with your objectives and constraints, right? So candidate portfolios that are compliant, and that is beyond the legal word of compliantly, kind of the mathematically compliant word with the 3Cs, consistency, coherency, and completion of the definition of objectives and constraints. And one of the tools that we often use is looking at, sorry, just quickly, these set of green lines, which are, often when people see this graph, they think, oh, it's a simulation of the market. But no, it's one evolution of the market. So it's actually what really happened over this period, so December 19 to April 20, with all the possible, a very broad sample of all the possible candidate portfolios that PM could have built in December 19, based on that PM's particular asset selection, asset convictions, objectives, and constraints. And the point is that the spread of possible outcomes is pretty broad for what was, in many ways of thinking, the PM has done his job. It was a he in this case. The PM has done his job. He's selected his assets and he's compliant. But the outcomes are quite broad depending on exactly how he builds his portfolio. And that's what you can see here. And what we do and what we want to talk about here is, how do you calculate what's the best candidate? How do you choose between them? So so thanks, Steve. So the first thing to think about is like, what does best mean? And there are lots of ways of doing best if you are absolute about stuff. So if you say, I take the historical market data set and I believe the future will exactly replicate the historical market data set. Clearly, the best portfolio is to put 100% into whichever one performed best in the last, whatever that period is, right? Now, that's nonsense, right? We know that's nonsense, right? But that is one method of taking a market data set and calculating best. And there are lots of other methods of doing that too. And you can sort of plot them out, and we plot them out on this kind of graph, right? And you can say on the y-axis, you can look at how good are you at asset selection, right? So if you're up at the top, so the highest number on the y-axis, basically you know everything that's going to happen in advance. Well, I mean, well done. You don't need us. That's great. Just give me a call. If you're at the bottom, you have no alpha. Your asset selections have no information value. So the top is not possible, and the bottom, well, you're definitely not in the business, right? The people who are running money have alpha. That's their profession. So you're somewhere in the middle on the y-axis. On the x-axis, similarly, you can have a market which is exactly what it used to be. So just take the historical market data, and that would be on the very left-hand side, and that's sort of the old mean variance minimization stuff. Or you can say there's a market which has total randomness, and we don't know what on earth's going to go on. And take some first or second moments of the market data and use that at the very most. But the truth is, it's somewhere in between. So you end up with this. If we move on, you end up with this sort of area in the middle of the uncertainty space in which you're going to live. Now, what we're saying here is you as a PM in your asset selections have some information value, but you don't actually know what it is. I mean, you're going to say in your risk meetings, I think this is going to go to 30% and this is going to go to 25%. But we all know that's, that might be the center of some possible future evolution, but it's not actually what's going to happen. But statistically, across your full set of views, there is some value. So you're somewhere on the y-axis in that cloud. And the market itself has some preserved covariance structure, right? You can argue against this saying the historical data has no validity, in which case no data-driven process can help you, which is fine, and that's a point of view. But if you're in the world where you think data-driven processes can help you, and we clearly do, and we have all the evidence to show they do, then you say, okay, what about the historical data matters to us? And what is likely to be preserved? What does that tell us about the future? And it turns out the historical data, as long as you don't think everything is a momentum trade, so trend, right? Forget about the trend component. But the thing that does stay relatively stable over time is the market covariance structure. And again, it's not perfectly stable, but it's broadly stable. And so when you want to evaluate, remember, we're talking about evaluating candidates. What we want to do is we want to evaluate them across a whole set of market data that lives in this cloud area. Actually does live in the cloud too, in modern parlance, but lives in this cloud area. So Sherpa creates these sets of market data which contain your alpha, but never too sure exactly where and when, with some stochasticity, and broadly preserves the market covariance structure. So that gives us a universe of future evolutions of the market which capture your alpha and capture the market structure. And against that, we now want to evaluate all the possible candidate portfolios against levels of risk. And again, what do we mean by risk? Well, we think it's very important that risk is viewed as in the same measure, the same unit of measure as a business experiences. And so, you don't measure risk in linear P&L. You measure risk in a very asymmetric P&L. As you lose money, you become more and more sensitive to losing money. As you make money, actually you become less and less sensitive to making more money. And the really important component of risk particularly within running institutional or third-party money, is at what point are you existentially threatened? Right? At what point do your LPs say that's enough? And so this picture, and again, we've done webinars on this in more detail, but this picture shows the risk function, or the shape of the risk function that we use to evaluate the candidate portfolio. So we take the candidate portfolios, the left-hand graph, each of which is going to live on one of these lines as the world goes forward. We take a whole bunch of possible market data sets which represent possible future evolutions of the world in which you have some information content but never do shoot where, etc., etc. And we evaluate them against a risk function which reflects the business reality of what you do. That's really important. Right? It doesn't reflect an accounting P&L. It reflects the business reality of what you do. This is not a sort of risk-neutral quant calculation of VAR that goes to regulatory approval stuff. This is a proactive way of taking risk in the best way to match what it is you want to do as a business across what the market could do and what you're allowed to do by candidates. So candidates are what you're allowed to do. The blue cloud is where the market could go, assuming you have some value in your ideas. And the 3 or 4 lines are the lines that describe your experience as a portfolio manager. They basically define or describe your experience of LP interactions. How nasty does it get on the left-hand side? How positive does it get, and where does it start tearing off? So that's the sort of the calculation. And I think, yeah, we've done webinars on each component of this independently, and it's all in the library. But this really ties it together to show how the calculation happens without actually getting into the maths of how the calculation happens, right? That then spits out, okay, here's a portfolio. The next part, or the fourth part of our 5, is explaining that portfolio. And this is important because, as with any remotely technical process, the output can appear to be a bit of a black box. And that goes for anything. Sorry, I'm just noticing it's very dark behind me, so it feels like I'm in a horror movie with a screen light on my face. The output of any sufficiently technical process can appear like a black box. So the fourth part of our world is explaining the portfolio. Why is the output good? How should you look at a portfolio? Can you take a snapshot of your current portfolio? Don't worry about the Sherpa calcs, and look at it and get an idea of whether it's a good expression of your alpha given your constraints and risk appetite. So the way we do that is by kind of, again, taking a step back and saying, well, what should a good portfolio be? Right? A good portfolio, just in the sort of abstract, should have some driven by what your view is on the assets. So things you like more should have higher weight, risk weight, or some sort of weight, sensitivity, than things that you'd like less. Okay, they should be moderated, so that upside view should be moderated by the downside view on any given asset, so the downside risk of the asset things. On top of that, actually, probably more importantly, they should be moderated by the way that the downside of that particular asset interacts with the downside of everything else. So you could have an asset that you kind of moderately like, and it has terrible downside risk on its own. But when it falls, everything else in your portfolio does extremely well. That is more weight than the degree to which you like it. Makes sense. And then the fourth thing that drives it, of course, are the constraints. You must have 20% in technology and the yield of whatever, etc. And so when we look at those for things, we end up with an approach, a visualization, which we call the risk quality graph, the RQS, risk quality score graph. And it shows, and again, we've done a full webinar on this, but it allows you to look at your portfolio and go, okay, what's odd about my portfolio? And actually, if you look at this portfolio, I think the next slide shows it quite well. If you look at this portfolio, can you flip forward? Any given asset lives on a vertical line, and the Sherpa weight for the asset, which is highlighted by the arrow, is down at the 1% line. So whereas the portfolio manager has got it at like 5.5%. And the point of the picture is it tells you very straightforward. It's like, if you have got that asset at 5.5%, that's why it's dark, thunderstorm, that's a, you've got that asset at 1.5%, at 5.5%. You must like it more than you've said you like it, because its risk attributes, when you mesh it up with everything else in the portfolio, are insufficiently positive to give it that weight. And actually, Sherpa says it should be at 1%. So it could be you like it more than you've let on in the very first part that Stephen talked about, defining a thing. It could be actually that the risk attributes are not very well caught. But you can't, it's not consistent. Its current weight is not consistent with the optimal way, given the calculations we just talked about, of building your portfolio. So the risk quality graph shows you a way of looking at your portfolio and asking yourself, it asks you to ask yourself, why is something where it is? And we kind of zero in on the truth of, if something is out of whack, the truth can really only be you like it more or less than you've said you like it, or it is more or less risky than the data says it is. And they are both perfectly valid reasons to put something where it is, but they should be in the overall process of running portfolios. They should be explicit reasons. They should be part of your conversation with your salespeople, CIO, LPs, because otherwise you're likely to get blindsided.
That's a discussion we have all the time, where we look at this visualization with clients, and it turns out that they do, in fact, have more conviction in an asset than they've stated. And they didn't really think about it that way until they see something that says, well, based on what you've told us, you probably got too much weight in that asset. And so it's something we run into that all the time. And this is a really easy way for people to understand.
It's really important to, in everything we've talked about today, it's really important that this is about putting a framework in place where you can be explicit ex ante about what you're doing. And that avoids the ex post unpleasantness of being blindsided by something happening. So if you said up front, I've got higher weight than the recommended because actually blah, 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 blah. And then you were wrong about blah, blah, blah. Well, that's actually okay, because you're not meant to be right all the time. But what you shouldn't be is be surprised. That's the one thing people don't like. And just, I think this is sort of a final thing. When you do this calculation correctly, and this is a genuine example from a real PM, the PM's portfolio is the red line. So of all the possible candidates, he chose the one that's the red line, which is the 50th percentile of where he could have been. So that means, he hasn't done anything ridiculous. He hasn't bet the house on black and blah, blah. He's built a relatively sensible portfolio. But because he wasn't so risk aware, despite having good selection, good scores, whatever, he underperformed what he could have done with a little bit more systematic approach. And Sherpa gave him like 250 bips per annum better returns, which is our sort of standard number. Take you from the 50th to 60th, 65th percentile possibles of what you do.
And that's where, this candidate portfolio, which again, we talked about in another webinar in more detail, but that's where this is one of the tools we use to help explain what's working, what's not, to help explain what was good about a portfolio after the fact, ex post. Whereas the risk quality graph that Richard went into such detail about, something that's more about ex ante, why is the portfolio good going forward. So the last segment of our 5 stages is manage and managing the workflow. So if you're doing all of this right, and you get to the end and you've built the portfolio and you've built the best portfolio and you feel like you have a very good understanding of it, this is an ongoing process. You are going to have assets come into the portfolio, assets go out of the portfolio, and keeping this process flowing and functional in a way that the PM is doing this consistently and driving the value and realizing the results they expect is really what the management component is all about. And so, when we think about management, we always think, if we look at work we did with one of our larger clients, this is things like establishing rebalancing frequency. This is refining the problem setup, because over time the problem definition might change a little bit, or over time you might see things that come up out of a given portfolio, a given solution, that suggest that maybe the portfolio definition isn't quite fully complete yet. This entails regular conversation, so regular meetings to make sure that everything that's coming out of the analysis, everything that's happening with that portfolio is well understood, and that those ideas can be implemented, and that those ideas are being implemented. Or if the ideas aren't being implemented or can't be, again, what do you need to refine in your definition and in your construction to make sure that they can be? And then ultimately, you need to step back. And this is something that's really hard for PMs who are in the weeds and they have a million different responsibilities and they have ongoing projects for ESG and they're being trotted out to talk to their investors. But sometimes you have to step back and look at the process and say, how are the different components working? And so that's sort of a full review of the entire process. Now, when we think about that, what this means is that a lot of that it's business operations. It's making sure that there's communication, it's making sure there's consistency, it's making sure that there's process in place. Part of this, though, is again a question of measurement. And so again, we won't go into the details here, but if we were to take some of the ideas from what we've talked about earlier in the webinar, so this is an example of a regular review of reviewing 5 or 6 months worth of data to say, are my scores doing what I expect them to do? So are my higher conviction ideas outperforming my lower conviction ideas? How's my sizing? If we said that in that previous example, the portfolio was in the 50th percentile in that period, and there was 2.5% of higher returns that could be captured by moving it up to, say, the 70th, how am I actually doing? Am I leaving a lot of money on the table? Is my sizing improving through time? And so this type of feedback helps identify the things that as a PM you can improve, or the things as a PM that maybe you need to consider a little bit differently in your portfolio construction. If your sizing is working well consistently, period over period through time, maybe you can lean into your convictions a little bit more. Or if it's not, then maybe you're basically running a portfolio where the curation of the list is more important than the differentiation of the names between the different parts on the list. And so by doing this, we can start to then help the PM make actionable improvements. So when we look at this and then we say, okay, well, by and large, their high conviction ideas have been outperforming their low conviction ideas. And if we look at the names over time that were consistently the highest conviction and they're doing even better, well, this would suggest that this PM really needs to lean in and really take more risk. And this is something that fundamentally most of the clients we work with, this is something that they could stand to do, could stand to use risk-controlled portfolio construction to allow them to take more risk where they have strong convictions and to allow them to get more exposure to those high conviction ideas. And so by managing the workflow, you can see this over time and you can help the PM improve the process, and a PM can help themselves sort of really understand what they're good at, maybe what they could use some help with. So we've gone a little bit over time, so we've covered a lot of territory here. But just to reiterate, so this is 5 steps, and whether you go through and use Sherpa's maths or use another mathematical tool, whether you do this purely old school kind of heuristic traditional discretionary management, the 5 steps that you need to be thinking about in terms of going from alpha generation to having a portfolio that can be sent to execution. Understand your alpha, understand your ideas, understand your tendencies. Define explicitly ex ante the shape of the portfolio in such a way that it's complete, consistent, and coherent to fulfill your organization's requirements. Calculate, so bring whatever consistent, ideally mathematical, but there's many ways to cut that tool to bear to produce the best portfolio that expresses one consistent with two. Explain and understand that portfolio, so make sure that you understand and can defend why the portfolio is positioned the way it is. And if it's not positioned in a way that you can defend, revisit 1, 2, and 3. And then ultimately think about how you can manage the process to make sure that through time, you're capturing the value of a rigorous process-driven view on portfolio construction. And so if you do this in the Sherpa world, what we see with our clients, what we see with other people we know who aren't clients, but who use a similar type of process-driven focus on portfolio construction, this gives you a better portfolio. And better means improved returns, lower drawdowns, and a better, more scalable process. So if there are any questions, we'd be happy to take them. We have a few more minutes, and certainly we don't want people to go away questions unanswered. Richard, did you see any questions come in? I think you're on mute because of your thunderstorm.
The rain taking over.
I hear the rain.
Hear the rain. Yeah. So I'm calling from my cave under the mountains here. The question, and actually this is a question that we get quite a lot, was what really is different from just using the standard optimization that lots of people have heard about and many people have tried and generally not got particularly good answers for? And really the answer is as on that slide. The standard optimization tools or workflows or strategies that people use is one small mathematical tool, which, if you remember back to the cloud and thing, gives you typically not a great tool because it gives you one answer that lives in the one corner of that cloud picture. And without the pre-work to understand and define, and without the post-work to explain and manage, you get a bad answer because you haven't really done all the pre-work properly. And that's it's not reflection on sort of bad intent or anything. It's just that actually that pre-work you're never taught how to do that pre-work, right? You have to really think, it's a specialism of what we do. We really think about this stuff. So if you don't do that pre-work properly, and you don't do all your definitional stuff, and you don't hammer out your inconsistencies, which sometimes is a painful process, right? Because the motivations of the PM and the investor relations and the CIO could be very, very different. But ultimately, it's one product. So this stuff has to be hammered out. If you don't do all this properly up front, then the machine will spit out a number and you'll look at it and you'll be like, that's crazy, and throw it away. Or it'll spit out a number and you go, okay, well, but why? Because you haven't done the explain component, you won't be comfortable with the number. And even if you get comfortable with that number, the workflow around it to make sure that next week you're still comfortable, or the week after, or as the market changes up. So fundamentally, the brief answer is the optimization part, which is the calculation engine, is 10% of the problem. And in most cases is done in a very simplistic manner, not encompassing all the stuff we talked about. But the real value for the business is in the other 4.9 steps.
Yeah, and I think this is something that I've talked to a lot of the providers on the data platform, so that the terminals that sit on people's desks. There's a handful of them, let's say. And they are upfront about the fact that what they deliver and what you can access there for optimization is a tool, and you're on your own to do all of the rest of it. And if you can do all the rest of it, or if you have someone on your team who can do all the rest of it, or if there's a resource in the organization that can do all the rest of it, great. But practically speaking, most PMs are very focused on the alpha generation part of their job. And the rest of this process is something that, to make the calculation step work, you can't cheat on the rest of the process. And to have the time to learn and understand all of those pieces of the process, and then to learn and understand how to operate another tool, I've almost never talked to a PM who says, you know what I'd really like are more tools on my desktop. And so at the end of the day, that's something I always view as a key difference, is that you have to do this process to make the math work. And you can do it, you can use any number of mathematical tools to do it if you are doing the whole process, but you have to be committed to actually using the tool, using it properly, and doing the whole process around the usage of the tool. So I think looks like we've gone kind of over time. Richard, anything else you wanted to make sure we covered?
No, I think very good. Thanks again, Stephen, for putting this together. And yeah, very good.
Well, I'd like to thank everyone for participating. Again, if you had to jump out early, if you came in late, this will be on the Sherpa Funds Tech Process Alpha YouTube channel, probably tomorrow, depending on where you are. Might be yet today if you're in the US. But so we'll have this up on the Sherpa Funds Tech YouTube channel. Most of the topics we talked about today, we've talked about in previous webinars in more detail. And so this is sort of a summary version, but if there's anything we talked about today that you want to dive into in quite a bit more detail, again, all those videos are on the YouTube channel. So please check those out, and we will look forward to seeing everybody next time. So thanks again. Thanks, Richard. Thanks, everyone, for participating, and we'll see you again soon.
Thank you very much.